Hi, Greg Weldon here with you for the Global Macro Strategy Report. This is Friday, December 12th. Today, we're going to talk about the U.S. dollar. The dollar is virtually persona non grata. When you talk about some of the moves we see in the currency markets where the dollar is getting smoked here, and the currencies that the dollar continues to be in a bull trend against, the list is a list of currencies that are really not major players on the global stage. Sierra Leone, Cuba, Azerbaijan, Libya, Mozambique, Belize, Algeria, Ethiopia, Fiji, Bahamas, Oman, Qatar, New Guinea, Pakistan, Iran, Turkey, Argentina. That's where the dollar's strong, all right? Or in the places where they're local to China but closer ties to the U.S., Korea, Japan, the Philippines, Vietnam, and to some degree India. All right, but the dollar is breaking down in a long-term secular way against a long list of wide-ranging different types of currencies around the globe right now. We're going to look at this again. We started this examination a little bit last week, or whether it was, last week with our dollar focus. We're going to expand that today, especially since I think currencies, these could be the trades of the year for 2026. Let's start with the dollar index. Already what would be a 4-year low on a year-over-year rate of change basis, all right? If not a 15-year low, if you get below the February 2018 minus 11.7 peak decline in the dollar on a year-over-year basis. Last year at 7.97, all right, June of this year, you were 8.12. That's the 4-year low. You also have May of 2021 at minus 10. You have a straight line to the downside here to breach like crisis territory, in terms of dollar depreciation, meaning commodities higher, inflation higher, the economy rolls over. In terms of technically speaking for the dollar, this is a really long-term dynamic you have going on here right now. When you talk about, this rally in the dollar to where it got to be too strong for the group of seven, they got together in New York, the Plaza Accord. I remember getting on the train Monday morning, the day after that meeting, when they announced that they wanted the dollar lower and we're going to work the dollar lower, and this was the G7 agreeing, all the countries would be involved, there would be intervention and so many yards. It marked basically becomes the all-time peak in the U.S. dollar. Everyone said we want it lower. It's good for global growth, and to whatever extent you're relying on the consumer then, and it was. So the degree to which you then had this massive bear market, a 50% correction, finished the next wave of the bear market, a double bottom 2008-11, and then an A, B, C, perfect 50% retracing the entire move. And now you're on the verge of breaking the uptrend line that goes back to 2011. Moving averages, the 2-year and 5-year secular term moving average is about to cross over negatively. You got bearish divergence in this entire new high in the dollar on my proprietary long-term oscillator. You're about to break down, about to go negative, and the stochastic has rolled over. Do we need to have more? Well, I got a lot more. Here's the close-up. You get below this level, 96.21 is key. You've seen it on the weekly chart. It's a double bottom there, too. You see there and there. And it's a double upside reversal days and weeks created bottom, which even makes it even more critical from a technical perspective. And you see here the moving averages, the stochastic, the oscillator, the whole 9 yards. This would signal the next big bear wave in the long-term secular bear market of the dollar, which would mean you're going below the lows in 2008, 2011, meaning below 70.